On March 18, 2026, the Federal Open Market Committee voted 11-1 to hold the federal funds rate at 3.5 to 3.75%. 11 members, including Chair Jerome Powell, voted to hold. 1 voted to cut. That split, the widest since the 2008 financial crisis, carries more information than the rate decision itself. Over the past 20 years, FOMC dissents have occurred in roughly 5% of meetings, averaging 0.2 per session. The committee meets 8 times per year in Washington. Most sessions end with every member aligned. When a voter breaks from consensus, it signals that the internal models at different Federal Reserve banks are producing meaningfully different outputs. The last FOMC decision with no dissent was May 1, 2024, when all 12 voting members held rates at 5.25 to 5.5%. Between that unanimous hold and this 11-1 fracture, the Fed cut 3 times, paused, and now faces an open disagreement over what comes next. The current 3.5 to 3.75% target range has held since December 2025. The Fed reached it through 3 consecutive 25 basis point, it's in September, October, and November 2020, reducing the rate by 75 basis points over 3 months from 4.25%. The easing cycle ended in December because the geopolitical environment shifted between Thanksgiving and year-end. Oil prices surged as the Iran conflict disrupted supply routes through the Strait of Hormuz. Energy costs fed into wholesale and consumer inflation readings. Core PCE, the Fed's preferred inflation gauge, stabilized above the 2% target rather than continuing its decline toward it. Powell and the 10 other members who voted to hold cited this evolving risk balance in the post-meeting statement. Inflation was no longer on a clear downward path. Cutting further into an oil-driven price shock carried the risk of reigniting broader inflation expectations that the 22 to 223 tightening cycle, totaling 525 basis points, had worked to break. The majority's case rested on the Fed's dual mandate, codified by Congress: maximum employment and 2% inflation. In March 2026, headline employment data supported patience. Unemployment remained below 4.5%. Monthly job creation continued, though at a slower pace than 2024's average. The inflation side favored caution. Oil prices linked to the Iran war had reversed the disinflationary trend that justified the fall 2025 cuts. Energy costs passed through to transportation, manufacturing, and food production within 1 to 2 quarters. The FOMC statement referenced incoming data, the evolving outlook, and the balance of risks as the framework for the hold. Powell's post-meeting press conference in Washington reinforced the position. The oil shock introduced uncertainty the committee could not model with confidence. Cutting rates while energy-driven inflation pressures were building would risk the credibility the Fed rebuilt during 525 basis points of tightening from March 2022 through July 2023. For the 11-vote majority, holding at 3.5 to 3.75% was the defensible position. The lone dissenter voted to cut. That vote carries specific informational content beyond a policy preference. Regional Federal Reserve Bank presidents rotate as FOMC voters annually. Each brings models built by their district's research staff in cities like Chicago, Minneapolis, and San Francisco. When a president dissents, the divergence is typically in the models, not in temperament. Dovish dissenters historically cite forward-looking indicators that headline data has not yet reflected. Leading employment signals, including initial jobless claims trends, temporary staffing data, and small business hiring surveys from the NFIB, often deteriorate 3 to 6 months before the unemployment rate visibly moves. The dissent also implies a judgment that oil-driven inflation is transitory. A supply shock, not demand-driven overheating. Supply shocks resolve when the constraint lifts. Tightening monetary policy into a supply shock risks compounding economic damage in places like manufacturing centers in Ohio and Michigan without addressing the underlying cause in the Strait of Hormuz. The dissenters' vote was a signal that the Fed was already behind. Academic research on FOMC voting patterns, published by economists at the Federal Reserve Bank of New York, shows that dovish dissents precede rate cuts within 2 to 3 meetings approximately 60% of the time. The dissenter is frequently early rather than wrong. During the 2022 to 23 hiking cycle, Occasional 1 to 2 member dissents surfaced, but the committee maintained cohesion through 525 basis points of tightening. Before that, significant splits appeared during the quantitative easing debates of 2010 and 2011, when Thomas Honig of the Kansas City Fed dissented at 8 consecutive meetings over inflation concerns. In November 2024, the FOMC voted unanimously to cut rates by 25 basis points to 4.5 to 4.75%, with voters including Powell, Vice Chair John C. Williams, and Governor Christopher J. Waller. That unanimity arrived months after forward indicators had already signaled the turn. The March 2026 dissenter may be operating on the same timeline, seeing the economic shift before Bureau of Labor Statistics data confirms it publicly. Political pressure added visibility to the March 18th decision. President Donald Trump posted on Truth Social the same day, asking when too late Powell would lower interest rates. This continued a pattern of public commentary on Fed policy across both Trump terms, starting with similar posts during the 2018 tightening cycle. The market delivered its own verdict within 7 days. Home loan demand dropped 10.9% in the week following the hold, ending a 4-week growth streak built during the fall 2025 cutting cycle. Mortgage rates, which track the 10-year Treasury yield more closely than the Fed funds rate, remained elevated as the hold reinforced higher for longer expectations across the bond market. That 10.9% decline translates to thousands of delayed or canceled home purchases across the United States. The housing sector, which represents roughly 15 to 18% of U.S. GDP when including construction, furnishing, and related services, felt the Fed's pause before any other sector registered the impact. The March 18th dissent reframes the Fed's next 2 meetings. The May and June 2026 FOMC sessions will reveal whether the lone voter was an outlier or an early signal of a broader committee shift. If the Iran-related oil shock eases and Brent crude stabilizes below $100 per barrel, the inflation argument for holding weakens materially. The leading employment indicators the dissenters' models track will accumulate 2 additional months of data by the June meeting. If those indicators continue to deteriorate, additional committee members in Washington will face the same conclusion. The 3.5 to 3.75% rate sits 100 to 125 basis points above the Fed's long-run neutral estimate of approximately 2.5%. That gap represents room to cut without entering stimulative territory. The dissenters' position is that this headroom, combined with forward labor market weakness visible in district-level models, makes the case for action at 3.5% rather than waiting for confirmation at a higher economic cost. The 60% historical hit rate for dovish dissents predicting near-term cuts suggests the May meeting is the one to watch. Subscribe to the Ledger for the signals inside Fed decisions, the models behind dissent votes, and the rate mechanics that move markets before headlines catch up.